Hi, everyone. Welcome to the Timing Research Show for June 29th, 2015. Today we will be talking about the 90-second weekly report from Timing Research. And if you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any past report there. I have Dave Landry here, guest hosting for me again this week, and so I'm going to go ahead and turn it over to him.
Okay, David, thanks for having me back once again. Thank you, David Kosminer. Thank you to TimingResearch.com. I'm glad to be back here. Looks like we had a pretty full lineup today. Let's start with you, Dan. Tell us a little bit about yourself and WallStreetSectorSelector.com.
Sure thing. Thanks for letting me come on today. I really appreciate it. It's my first time on the show, but it's not Wall Street Sector Selector's first time on the show. I'm the investing editor of Wall Street Sector Selector. We've been in business for about the last 5 years, and we focus on sector rotation and ETF trading as a way to make money in any market, whether it's a bull or a bear market. We always say that danger comes hand in hand with opportunity. There are always profits to be made. There's a bull market somewhere. So we take that focus and put that into ETF as we see ETFs are the best weighted market.
Okay, cool. All right, Jason, you're up next. Jason, I always have trouble with the name. Jankovsky, is that right? Close enough?
Yeah, close enough for hand grenades. Can you hear me okay?
TheLionOnline.net. Jason, to you.
Good. Hi, good morning, or actually good afternoon, everyone.
Thank you.
And to the Daves, thanks for having me on again. What I do is basically focus on psychology as far as entering and exiting the market and understanding what opportunities are available. I personally offer lots of help on building a good market presence and learning to understand your own personal psychology, do lots of training and coaching and mentoring for students in the marketplace. And here to give you my sage wisdom, counsel, pearls of advice for today's broadcast.
Okay, cool. Okay, next up we got Thomas DeLello of OrderFlowEdge.com, another veteran of the show. Welcome back, Thomas. Tell us a little bit about your trading and tell us a little bit about OrderFlowEdge.com.
Good stuff. How you doing there, Dave?
Doing great. Glad to have you back.
Great. Thanks for having me back. Pleasure to be here today. I've been in the market since 1996, been around the block a few times, and I'll spare you all the gory details about how I jumped from one thing to the next looking for the Holy Grail.
Like all of us.
Yeah, like everybody. But in the process, like everybody else, becoming an expert in what didn't work, but finally coming to the realization that the main challenge in becoming a successful trader is, when it comes down to it, is to understand the actions and strategies that the successful traders in today, what the HFTs are doing, what they employ, and how they differ from those of unsuccessful traders, and try to emulate what they're doing in the market as closely as you can. That boils down to trading in the direction they're trading in the areas they're trading in, and basically using order flow information to confirm their activity. And, the basic ideas of order flow and tape reading, the supply and demand and the smart money running the stops, that form the basis for a methodology. They've been around forever. Wyckoff, Livermore, early 1900s all spoke of the smart money and the composite operator and how they accumulate inventory at lows. They turn around, push the market up to hit stops so they could distribute into stops at higher prices where they sell their longs and get into shorts, and it's the same thing back in the opposite direction. It's the same.
Isn't that amazing? I'm reading a book by Sheldon, which was published in 1912, and they cover the same exact thing. It's just amazing.
It's the same stuff being played out over and over again.
Human nature never changes. Cool stuff.
Absolutely.
All right, next up we got Steve Lentz of OptionView.com. Steve, welcome back to the show, and tell us a little bit about your trading, and tell us a little bit about OptionView.com.
Thanks a lot, Dave. I'm with Discover Options. We are the educational arm of OptionView Systems International. We have, since 1983, we've had the high-end option analytics software program, and I joined the company back in '98. And then along the way, we ran a CTA, and then eventually got into the mentoring, and we brought in some guys that are professional traders, and we offer mentoring courses in doing option overlays. We do directional spread trading and then non-directional spread trading as well. And so we have some, something I'm doing in my teaching is some interesting angles on volatility and looking at what the predicted move is versus what actually happened, different take on IV and statistical volatility and historical and all that. But it's glad to be here. Thanks for having me on.
Yeah, glad to have you. Okay, I'm Dave Landry. We got a full lineup today, so I don't want to talk too much about myself. DaveLandry.com. Just real briefly, I believe that only the short term can be predicted when it comes to the markets, and I'm slotted as a swing trader because of that. But I'm willing to stick with a position as long as it moves in my favor. I trade mostly stocks because I believe that the best opportunities come in inefficient markets. And we take a short-term profit when offered, and we trail a stop higher to hopefully stay with that market for a long, long time. As far as predicting the markets, it's akin to predicting the weather. I'm looking outside now. It's getting cloudy, starting to thunder. There's a pretty good chance it's going to rain soon. And predicting the markets, the way I look at it, is akin to predicting the weather. Only short-term forecasts are viable. You know if it's going to rain soon, but you don't know if it's going to be raining this time next week or a month from now. Anyway, I have a 21-page report that outlines all of that. The rest is just details. If you go to my website, click on free reports on the home page, or click products and then free reports, you can get a copy of that. Okay, let's go over to you, Dan. First question this week is, it's a two-part question actually. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower? And that's Mondays to Friday's close, the close of July 3rd. We've got an early close this week due to July 4th. And then based on your answer, rate your confidence on a scale from 0 to 10, with 0 being no confidence, and that means a 50-50 chance, with 10 being, he tried to say, extremely confident. So to you, Dan.
I had one thing I wanted to say here real fast.
Okay.
I had on the survey, I had a slight typo. Well, I had a typo. It said August 3rd instead of July 3rd, but I think most people figured out when I said next week what it understood what I meant. But there was one person in particular in the comments section who was very upset about that typo. So
so you're
yeah,
you're ahead of your time.
I made a mistake, and so anyway, that's all. Go ahead.
All right, Dan, to you.
Yeah, for sure. So I think I'm predicting the market will go down this week, with the caveat on Greece. I think Greece is on everyone's minds. It's the largest issue that we're facing this week, and especially in the last couple months. As we all know, Greece owes a lot of money to the IMF tomorrow. They also, the Greek legislature, if you will, passed a referendum that will be voted on the 5th of July. The 5th of July is after tomorrow, and I think, if Greece does indeed miss its payments tomorrow, which it looks like it will, today's declines, if you will, in the stock market might be even greater. That being said, if some sort of agreement is reached with Greece and its creditors overnight or in the next few days, it could be grounds for a heyday in the stock market. So I say it very confidently, 10 out of 10, that the market is most likely to decline this week, given that the situation in Greece. Although Greece itself is very small, and U.S. banks aren't really exposed to Greece, I think the ramifications of a default and exit from the Eurozone are much larger, especially given the activity within the Fed over the last few weeks, and given that the Fed will decide on whether to raise rates or not come September. If a Greece exit or a Eurozone financial crisis breaks out, I think that could have adverse effects on the Fed's decisions to raise rates, which could keep the rates lower. That's why I'm bullish in the long term. That being said, Greece, I think, is on everyone's mind, and this week I'm very bearish given that situation.
Well, last week we talked about doing a shot of Ozo every time the word Greece came up. All I could find in the cabinet was some Sambuca, which I guess is close enough.
Well, and plenty of shots, because I said Greece about 50 times. So.
Said it again.
I went on and got a bottle too of it. Last night.
Oh, you got a bottle over there. Oh, okay. All right. Okay. Good. Well, I'll wait till it comes to me to chime in on that, and then we also the next question you'll get to elaborate a little further. So I am interested in hearing some more about that, because as far as I'm concerned, it just looks like a little speck out there in the ocean. But we'll talk about that in a second. Let's go to you, Jason, first. Jason, based on any technical or fundamental indicators you want to use, would you predict that the S&P will close higher by the end of this week? And that's for Monday's open to the close of July 3rd.
I think we're going to be lower because we've had recent, near record highs have been almost all the time in the last couple of weeks, last couple of months. And the Greek thing, I think, is on everybody's mind. I would totally agree with that, except I don't think the market's behavior in the past week and a half, 2 weeks, really says that it's that big a deal. I think people are discounting it. I think it's baked in the cake already. I think the reason the market will be lower is because it's a 3-day weekend coming up. And I think that people are just a little nervous, a little scared, not sure if they want to hold. It's the doldrums for summertime. And I think people are just going to look at this saying, well, that's the end of the quarter is on the 30th for June, right, tomorrow. We got 1 or 2 more days where we can fine-tune this or window dress it, but I think it's probably done till maybe September. So I think it's a regular seasonality psychology trade. I think the Greek thing is already baked in it, so I think it's a non-event. I think that's been on everybody's mind for so long. They're just tired of hearing about it, and I think really they're looking for something else, and I think they're going to look at the seasonality features that the market tends to have from during the summer months, and then that's it. I think they'll be quietly closing positions by the end of the month. By the end of the week, beginning of July, for the 3-day weekend, and that's that. I think it's going to be a very quiet end of the week, but I think we'll be a little bit lower.
Okay, Jason, what's your confidence on that?
My confidence on that, I would say about 80%. I would say pretty close to that.
Okay. Let's go to you next, Thomas. Based on any technical fundamental indicators you want to use, would you predict that the S&P 500 will move higher or lower by the close of this week, July 3rd? And then on your recommendation, on your opinion, give us a confidence of 0 to 10.
All right, this is the part of the show that I like the least. I'm going to make these predictions, these long-term predictions. I'm doing it because you guys have a gun to my head. But, again, it's like everybody else said. It's all about the Greek news, what's priced in. I have no way of knowing what's priced in, what isn't priced in. I think obviously, if it is true that they're going to leave the euro, things can get a bit crazy. What's going to happen in the next few days, who knows? I just find it very hard to believe ultimately they're gonna let them default from the euro, because I think it just sets a big precedent for other countries, the same thing to happen down the road. I'm gonna put in a little bit of controversy here and go the other way and say I think the market's gonna be higher by the end of the week.
Okay, cool.
Confidence factor of 7, and a lot of that is based on inventory in the market. Now, don't get me wrong. If news comes out, negative news on Greece, forget it. The market can just find new sellers. But we're at a technical point in the market looking at long inventory and short inventory. There's a lot of short inventory built up in this market and very little bit in the way of long inventory. So those longs can get squeezed, and that will provide some fuel to the downside. But there isn't a whole heck of a lot of long fuel to fuel the market to the downside. So if there's no negative news, I think we can find a bottom somewhere in this area that we're in here. Maybe closer to overnight lows that were put in last night. Maybe test those lows, see what's below there as far as stops, and then maybe bottom out and form a range here until more news comes out. Maybe head higher.
Okay, what's confidence on that?
I'd say 7.
7. Okay.
7.
Cool. Well, I'm going to go ahead and say higher, and the only thing I'm looking at is, and I hate predicted markets like this, because I said you can only predict short term when it comes to markets. But that's when you have a setup and you have like a solid trend and a pullback, and that's the type of sweet trading that I normally do with positioning it to longer term position. Now, the S&P 500 is a very efficient market. It does tend to chop around. I agree with what was said about the summertime doldrums and all. That was a good point. I'm glad you brought it up. A couple of you guys did. I'm getting a little feedback. I don't know if you know where that's coming from, Dave. But anyway, I'm going to go ahead with higher. If you look at the longer-term S&P 500, you could see that, let's say you put a 200-day moving average in that. We've had daylight above that 200-day moving average, meaning the lows are greater than the moving average. And I'm not going to pull it up this week because it seems to be a bandwidth issue for some reason, maybe with the 5 people in here altogether. But just take my word for it. Look at last week's or week before show. You can see that the lows of the S&P have been above the 200-day moving average for last couple of years, and the market's gone up about 90%, I think, since then, if memory serves. Again, I just took my charts down right before the show. So I'm going to go with higher, and I'm going to give it a confidence of 7. I'll elaborate a little bit on the Greece situation in the next segment. Steve, let's.
Hey, that glass was empty, Dave.
You busted me. All right, here we go. All right. So, all right, let's go back to Dan. Dan, the next question is going to be. This is where I think we're going to say that word again. What developing events, technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, without trying to say that word again, it's that one event across the ocean with the Mediterranean Sea. I think just look at today's market declines the day before their payments are due. Greece is in trouble, and since we're only looking at the short term, given this week, even today's 1.45% decline so far is going to be tough to dig out of, provided, of course, some sort of magic happens with its creditors and with Greece, and a solution is reached. But I'm pretty confident that if payments are missed tomorrow, which it looks like they will be, even given the referendum on July 5th, I think we're looking at some heavy declines this week. That being said, the S&P 500 just dipped below its magic blue line. The market seems to be threading itself through a needle. It's stuck around that 2100 zone. Will it really vary that much? Long term, I don't think so, even given the Fed and the summer doldrums. And of course, that brings up my last point, the Fed. If this Greece issue creates an enormous problem worldwide, it could have adverse effects on what the Fed will do come September, given raising rates or lowering rates or keeping rates the same. But given this week and the short-term context, unless a miracle is pulled off tomorrow, which it's happened before, I think we're looking at steep declines.
Okay, cool. I mean, not cool in that, but good answer. Jason, let's go to you.
I'm not trying to say the word Greece over and over again.
Hang on. Jason, let's go to you. Oh, God.
Wait. Are you doing shots of Uzo in the lot? Is that what you're doing, Dave?
Yeah, every time you say Greece, man.
It's our drinking game for Greece.
Well, I mean, if you don't need much of an excuse, I guess, at that point. It's pretty much on the table, right?
Well, given today's market, Anyway, Jason, based on any what developing events, technical fundamental we'll be watching out for this week that might have a negative or a positive impact on the S&P 500 and other U.S. markets?
Well, yeah, I gotta agree with what I heard before. The couple of guys out there saying, look, miracles do happen. I mean, that's really the gist of it. There could be some, black swan event that totally turns everybody's head around. I think we got to expect the unexpected, really.
But that would be a white swan then, because right now everybody's expecting a black swan, I guess.
Right. Yeah, I guess you're right. Yeah. What I'm saying is the whole world is just so negatively inclined to this Greek situation. It wouldn't surprise me if somebody pulled a rabbit out of their hat. But the big question is, what's that going to be? When is that going to be? Could we expect that before the end of the week? So if we were to say, you know what, without that, I really think that the market is they baked it all in. I think that guys that are there's not many of them, but I know they're out there. Guys that are smarter than me. And I don't mean that, real aggressively. I'm kind of joking. There's a lot of guys smarter than me out there. I meant that. I didn't mean it to sound like I was being arrogant. But what I meant by that is that, guys that are out there that are smarter than all of us combined, those guys, they have already run this whole question over and over and over. They've already run the algorithms with the big question here and that variable there and what if, and what color tie is Mario Draghi wearing today? I mean, they have tried every which way from Sunday to figure out exactly what it is that would happen to the markets if Greece defaulted, if they had a late payment, if they left the euro. if they were able to put it to a vote to the populace, which apparently they might do this week, if there was a bank holiday, which now there is. Net, I don't see the panic happening. So I would say, what's the fundamental or other event that might cause some big move in the market? I think it's all in the cake already. I think everybody's going back to what they normally do, and by the end of the week, they're going to stick with their plan. And their plan is, until they get something definitive, it's a holiday week. They made money by being long. They probably got that hedged or protected. They're starting the month of July, it looks like, off the highs. They may by the end of Tuesday night. I think they're sticking with their first plan. I think that would be the basic rule set that most people stick with. You know, if you don't get that big event, that black swan or white swan event, if that don't happen, and we've been watching for it and waiting for it, and the world is just fed up with this whole Greek thing, and, you know, Greece is what, 1% of the GDP in the Eurozone anyway, or less? I mean, I just really don't see where there's I think the markets have had more than enough time to prepare for the worst and expect the best. Everybody's ready for that. They're all positioned. Nothing new is happening. Nothing's really changed, except tomorrow they maybe will make a payment to the IMF, or they may not. I think it's already, the market's already prepared for the worst, expecting the best. If something wonderful happens, that's great. I don't think it'll move the markets that much. Something terrible happens, I think people will use that to position against their longer-term time frame anyway.
Amen.
So you get a big sell-off in S&Ps. We may end there for the week, lower, but I think professional money be buying that dip.
Amen.
You know, that's me. So
okay, cool. Thomas, let's go to you. Thomas DeLello of Order Flow Edge. What developing events, technical fundamental, will you be watching out for this week? Negative impact on the S&P 500 and other U.S. markets.
All right, Dave, get your shot glass ready. Greece. It's all about Greece right now in the immediate. You know, like what everybody else here today has discussed. They're holding the referendum to decide July 5th whether to accept or reject the current bailout terms that are on the table. The big difference with this news over the weekend, I think, is the government imposed capital controls on the market, where essentially they're shutting down the banks till I think July 6th was the last I heard, in order to curb withdrawal drain on the system. That's pretty big. It's the first time that they've done that in Greece. So it'd be interesting to see how that plays out. Like everybody said, you got the IMF payment tomorrow. That very unlikely they're going to make that. But besides that, the same old stuff with the Fed too. And the central banks across the world, really. You know, they've backed themselves into a corner after repeatedly cutting interest rates to boost up the economy. These low interest rates have in turn fueled these little mini economic booms, which also encourage excessive risk taking. You know, which creates an unstable environment. You know, these little booms keep stalling, and you know the policymakers have responded to this whole situation with even lower rates, and that's their answer. You know, to boost the economy again and again. It's a vicious cycle where essentially they don't allow the market and the economy to naturally adjust.
Yeah. And
the result is too much debt. You know, too little growth, too low interest rates, and the environment that we're in is just toxic. You know, so. Again, it's these are the things that we continue to keep our eyes on, like we have the last couple of months. How it's going to play out, we'll have to see.
Good points. I mean, almost every show, if you watch some of the archives of these on YouTube, you'll see that I bring up the fact that years ago the Fed used to be fiscally responsible, and their job wasn't to make the market go up. Their job was to do what had to be done. And then at some point, I guess 10 years ago, maybe 15 years ago, that switch flipped. And they just try to do whatever they can to make the market go higher. And eventually, I think you actually said they painted themselves in a corner, and I fully agree with that.
Yeah, I mean, they're interfering with a natural market process. That's dangerous, you know. And the other thing here, which is kind of unrelated, but the holiday weekend, so July 4th, you don't get much more patriotic than July 4th, and these patriotic holidays seem to have a bullish outcome, so we have a nice mix of different things to pay attention to here coming into the holiday weekend.
Yeah, you guys have been around long enough, and I think I've said this before in the show, so my apologies if you've seen the archives, but you guys have been around long enough to where you used to come on, Fed, it's like, give us a quarter point. You know, we're up at 9% or something ridiculous like that, or you just had to beg them. and it's like they give you just a little bitty change in interest rates, if anything, and the market would be like, yeah, but now it's kind of like, they're out of control, nobody cares anymore. I guess the difference between us and that Mediterranean company is the country is the size of our printing press, from the way I understand things. Steve, let's go over to you. What developing events, technical fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, I'm going to be a bit of an outlier here, I suppose. I really agree with what Jason said about all these folks kind of factoring it all in, and there's a lot of money with a lot of brain power behind it, and so our approach here and mine is to just look at price. It takes all the effort I have just to understand price and analysis and using tools.
Amen.
Greece and banks, and might as well be Schmeech and banks, or Spanks. I mean, I don't know. I mean, I look at price and I assume that all those factors are rolled into it, and so then we just use various tools to look at price to try and see if there's any kind of predictability coming from those tools. And right now, unless I'm saying things, I see a huge confluence of indicators that are ready to flash bearish, long-term bearish. Point and figure. You have a triple bottom breakout ready to go that'll also coincide with a long-term trend line break. That trend line dates back years.
Yeah.
And that's all getting ready to go. And you can go to stockcharts.com, dial up a point and figure of the SPX, and you'll see it's getting ready to flash. At the same time, you have the Ichimoku charts that are now just today descending below the cloud. And if tomorrow price follows through today's low, well, you got the Ichimoku flashing a pretty good bearish sign there. Finally, you have a channel in the S&P starting back on March 15th, going and you draw an upward trend line to June 15th. That same trend line parallels the top of the channel. That's getting busted today, that channel is. And so when you have three different models from three different perspectives kind of saying the same thing. Now, the point and figure hasn't flashed yet, but it could. That's three that are right there. I mean, what's the reason for technical analysis except for moments like this, really? Because then if it does go down and then you don't get in and then you're looking back going, oh, I should have seen it. Well, here we are, right? So I'm pretty bearish at this moment.
Gotcha. I tried point and figure, and I found myself pointing to the chart and trying to figure out why I lost money. Now, point and figure does make a lot of sense. I don't use it personally, but I do agree with it. Anything that involves purely price and supply and demand, I'm a fan of. I probably could incorporate, if I had to incorporate a new type of charting into my charts. I agree with you on that. I'm not quite so bearish just yet. I'm going to let the market take a little bit more time to top. One thing I've learned from being around a lot of smart technicians, I'm a member of the American Association of Professional Technical Analysts, and one thing I learned by being around those guys is that the tops tend to be more of a process, and let's not get too excited in the first little downtick. But I certainly hear you as far as those things could, especially like you said, the point and figure. Once that flashes a signal, then we could have some problems with this market. I am a 100% technical trader. I try not to pay too much attention to what's going on, but I did turn on the TV last night because I was curious to see how futures would open up while I was at home relaxing with my wife. And one thing that I noticed on the crawl, it said that well, I'll just say Greece would possibly miss a $1.7 million IMF payment or some sort of payment, and 1.7 billion with a B. And I'm thinking, okay, that's a lot of money, but how much money is that really in the bigger picture scheme of things? And right before I shut my feed down, if I did my math correctly, and I confirmed it with another individual, and I think it's pretty close, our market is down $270 billion just based on the S&P being down 27 points. And if that sounds about right, let me know, or if I seem to be off. So that's significant move down for a $1.7 billion missed payment. So instead of, I guess, trying to figure it all out, maybe there's something bigger, like Dan was kind of pointing out. But I'm going to stick with price, and I'm going to watch the 20-day exponential moving average, a 30-day exponential moving average, and a 10-day exponential moving average, and see if they cross over. And I get what's called a bow tie, where they all kind of come together and cross over after the market just recently makes new highs, as it did. So I think that'll be kind of an interesting thing to watch. It'll probably trigger right about the time that point and figure trigger, so I'll certainly keep an eye on that. Longer term, I'm going to remain bullish until proven otherwise, and try not to chase my own tail. I think this is a little overblown, and but we'll see. It's the reaction to these events and not the events in and of themselves. Just one other point real quick. I'm friends with Greg Morris, and he often gives a presentation where he puts a chart up and he points out two Gulf Wars and 9/11, long-term capital management, and you guys have been around for a while. You probably remember that. You probably remember the Asian crisis. He points out all these things in the chart, and he points out all these things. He didn't point to where they are on the chart, and there's no way you can just look at the chart and figure out where they are. So longer-term news is really not that important. Shorter term, you have a little blip one way or the other. So I'm not going to get too excited about that situation in that little Mediterranean country over there. So, okay, let's go back to you, Dan. And the final question this week is, let me get to it. I had it memorized, but let me just double check it. Okay, between methodology, money management, psychology, what do you think is most important and why?
I think psychology for sure. And just look at today's reaction to what is seemingly a very small issue over in the Mediterranean. I think regardless of what anyone wants to say, anything technical, algorithm-driven or math-driven otherwise, people are emotional traders. People have emotions when they trade. So I think the psychology comes into play that you have to have a system that you can stick to and that you stick to no matter what. And I think I would say probably 8 out of 10, 9 out of 10 traders do not stick to their system when things get rough.
Amen.
So that's why I'm putting psychology first. You could have the best methodology and the best money management practices in the world and still lose every time because you don't stick to those systems based on your emotional reaction to whatever the market is doing, whether it's going up or down, whatever side you're playing.
Amen.
So I think that psychology is by far the most important out of those three, and then I would put money management as number 2, and then your methodology is number 3. There are a lot of people out there who probably lose maybe 4 or 5 times out of 10, but given their psychology and good money management practices, they're probably still making money, even though their methodology isn't the best. That being said, none of us have the silver bullet, so we really can only rely on the first 2 practices, a solid psychology and solid money management skills to make money in the market.
Amen. Amen. Good stuff. You stole a lot of my what I was going to say, but good stuff. Okay, let's go to you. Next time I'm going to talk. No, that's okay. Jason, you go. Next question. Same question to you. Between methodology, money management, psychology, what do you think is most important and why?
Well, I would be 100% in agreement with what Dave said and what you've alluded to before, is that it's psychology first, money management second. Your method, I believe, is actually incidental. I think you can flip a coin and do well in the markets if you know how to manage your own personal participation and you know how to manage money in terms of risk to reward ratios, how to make sure and roll stops to protect open trade gains or reduce your risk. Your money management is second to your psychology. Your system, I think, is incidental. I don't think it really matters. I really do. I mean, who was it? Richard Dennis, I think, one of the great traders of recent memory. He said, I could put my system on the front page of the Chicago Tribune, and people would still lose money using it.
Yeah.
It's got nothing to do with the system. It has everything to do with how you think and how you behave. And I think that's what. Boy, I wish we had unlimited time. This is a great group of people, a great group of traders that are together today having this conversation. And boy, I'll tell you, if we had the time to discuss it, we could solve the entire world's problems probably in the next hour or two.
I'll have a shot to that for sure.
Yeah, because I really think that trading, if somehow it could be communicated to the vast majority of people that are still having issues with gains and losses and not getting what they expect or deserve from the markets, I would say it's all psychology. After that, it's good money management, and then after that, Well, then it boils down to what your system is.
Yeah. All right, Thomas, let's go to you. Same question. Between methodology, money management, and psychology, what do you think is most important and why?
Well, I mean, at the end of the day, listen, all three are the main components, really, of any successful trading operation or entity, whether you're an individual trader or part of a prop firm, whatever. You can't trade consistently without having a handle on all three. And the balance of the three, I think, is going to be different for everyone. But I will say this, in my opinion, it's edge first, because for me personally, it's about understanding and trading the markets in a way with a methodology that will give you back your decision-making powers and enable you to compete in the markets alongside the smart money at their own game. And that's ultimately what will empower you, but you have to understand the structure, you have to understand what's going on in the markets, right? And to me, that's the only way to build a strong foundation, by trading with a robust, viable edge, and then you work on the money management and the mindset issues that might be holding you back, and that's what ultimately will take you to the next level. But without a working edge, a viable methodology, at least in my experience, you have no foundation. Everything else will just crumble. And I've been there, reading the trading psychology books over the weekend, looking for the answers. And don't get me wrong, they're all very motivating, and you come in Monday morning and you're motivated and you go back to seeing yourself get stopped out time after time.
Yeah.
And all that motivation you built up over the weekend goes right out the window because your methodology doesn't work. So you're back at square one again. So I think you need all three. That's my opinion, but edge first.
Absolutely. Well, I agree with what everyone says, and the question is, between methodology, money management, psychology, what do you think is most important and why? And my answer to the question first is yes, but if you put a gun to my head and I have to answer the question, I think I'd agree with what everyone said so far, is it would have to be psychology. One thing that I do, though, they are intertwined, and that's what people have to forget, that one thing does not exist in a vacuum in and of itself. So if you get better at your methodology, your psychology is going to be a little bit better. Like who just pointed out about the edge? Was it Jason that was talking about the edge? I got mixed up.
No, it was I want to say, I think it was Steve.
Oh, Steve. Okay.
I think I was talking about the edge a minute ago.
Okay.
That's
So
Thomas.
Steve,
Yeah, it's Thomas.
Okay, yeah.
Okay, so he was just talking about the edge, and that makes a lot of sense, because if you, in understanding your edge is important too. For instance, with my stuff, when the market starts getting choppy like it is now, you're going to experience a drawdown, you're going to experience fewer and fewer setups, and you might just have to sit on your hands. But a lot of people crave the action, and a lot of people are setup junkies in market. They want to trade all the time, and sometimes you just have to sit back and wait for your pitch. So you got to have the proper mindset to do that. But if you know that your methodology is going to have some flat times in there, you're a little bit better off waiting. Also, if you're controlling your losses, that any one loss is not a really big deal to your account. Emotionally, you're going to be able to handle it, and then that's going to allow you to follow your method. When I started working on a course on psychology about a month ago, and I thought, because if you look at it on the surface, it's like, okay, we're going to plan out trade and trade out plan, and that's it. And I realized, like, do I have a full course or not here? And I started just making a list of things that I wanted to put in it, and now I'm up to 10 pages of what I want to cover, because on the surface it's extremely easy, but in reality it's much harder. And it's kind of like the Mike Tyson thing, and one thing that I often say before we get to Mike Tyson is, I've never met an unsuccessful paper trader, and once real money is on the line, those emotional decisions, emotionally charged decisions, I should say, begin to rear their ugly head. And Mike Tyson once said, everyone has a plan until they get punched in the face, and that's the hard part, is once you get punched in the face, is to physically follow that plan. Trading psychology comes up often. I mean, I gotta have to stop myself because I could go on and on this. Steve, I forgot to put a check mark next to your name. Did you chime in on this one? I forget.
No, not yet.
Okay, sorry about that. Go ahead, Steve. Between methodology, money management, psychology, what do you think is most important and why?
I would agree. I think it's Thomas. You have to have all three. They all work together. You have to understand where your edge is. In options trading, if you're buying straddles in a market that is consistently less volatile than what the options premium implies, you're going to have trouble. And you just have to understand that. And likewise, if you want to try and sell premium in markets where the options are implying more activity than what actually takes place. And so you have to understand your edge, but then I would say too, money management really is managing your emotions and psychology. You can call it psychology management as well as money management. Those two are very tightly.
I like that.
It's all been covered.
That's good.
Psychology management. I made a note. I'm going to quote you on that one. It's what's amazing too is people, you get this false sense of comfort market, and you guys have all been around the block a time or two, and you never really do feel comfortable. And when you do, that's when you start feeling the most uncomfortable, because it's like, wait a minute, I know something is just around the corner, whether it be a little country out in the middle of Europe or something else. What's kind of interesting in last week's report, we posed these questions. I forget what the exact question was, but somebody wrote that, hey, I just been printing money selling spreads. And I thought to myself, well, the market's been in this stupid sideways range since last Thanksgiving, and that's probably a wonderful way to make money. But I think what they fail to realize is this market could break out one way or the other, and that selling strategy will work until it don't. Now, if you've got your head wrapped around it and you know your methodology inside and out, and you've got a way to mitigate those risks, you're going to do just fine. But if you're just blindly selling spreads in a market that's going sideways with decent volatility within the range, you're going to do perfectly fine. But you're not going to know what hits you, and that's when really the psychological mistakes will probably kick in too. We could probably spend all day on this, as you can tell, we'll probably I'll talk to David. We probably should continue along this trading psychology talk. I think it's that important. I mean, obviously, money management is crucial, and you got to have an edge to begin with. But if you don't have the mindset to follow the edge, then I think you're doomed from the start. Anyway, again, I didn't mean to go off, but I did.
I'll just go ahead and remind everyone here that anyone watching, or any of you guys, or if you ever have any ideas for questions, feel free to share them with me. And for those of you watching, you can go to TimingResearch.com/questions and submit a question there, or go to the contact form and send me an email directly. And if you have any suggestions or ideas for these weekly questions.
Okay, let's just. I think that's good for today. David, you want to go ahead and close the show up? And I guess before we do that, let's just go through everyone real quick. Dan, you have any closing remarks? Anything you want to mention? And anything else you want to tell us about Wall Street Sector Selector?
Sure. When I trade, and when our publisher John Nyaradi trades at Wall Street Sector Selector, we always focus on where the next bull market is. Let's just say that the world implodes tomorrow and markets die. We have a huge black swan event. There is still opportunity. That being said, if the markets go up this week and we see huge gains, of course there's an opportunity. So regardless of what happens across in the Mediterranean or elsewhere with the Fed, anywhere, just name it, China, emerging markets, anywhere across the world, even at home here, regardless of what happens, there is always an opportunity to trade, and that's why we focus on ETFs and sector rotations. So just remember, danger always comes hand in hand with opportunity. No matter what happens, just short of some sort of zombie apocalypse or something, the U.S. financial markets usually open at 9 a.m. every day, Monday through Friday.
Yeah,
I'll drink that as well.
There's a little controversy because it's not exactly true, but there's some truth in it. The Chinese symbol for opportunity is also the same symbol as danger. Let's go to Jason next. Jason, the Lion on. Anything else you want to tell us about yourself, your trading, or the LionOnline.net?
Well, no, nothing specific. Just for those of you that are new to what I do, Dave's going to put a link to a broadcast that it's an on-demand broadcast. You're welcome to attend whenever I do it. It's called Master Your Market Power, the 5 Key Shifts to Trading Dominance, and I'd love you to listen to it. We talk about psychology, the relationship between winning traders and losing traders, what winning traders have in common. It's not negotiable. It's not my opinion. If you really want to win, you've got to make these changes to your thinking and your behavior, and I offer a pathway to help you achieve that. It is one of many you could take, but certainly I feel that it's worth your time and effort to look, so I hope you get a chance to do that. And if I will leave anybody, because I don't know next time I'm going to be on the show, if I could leave the listeners with anything, I would say find a place to get short euro and stay there. That would be my that would be where I'd be at for the rest of the year. I think that
Okay.
there's a huge opportunity developing in the currency markets. I think the euro, when it's all said and done, in this little Mediterranean country problem, that is what 1% of their GDP fades from memory,
Yeah.
and the real issue starts to happen. I think that the money is going to be made on the short side of euro. It's not necessarily the dollar being strong; it's the short side of the euro. So that's
Gotcha.
I think that's something you, as a trader for the next few months, you need to have a macro view on.
Well, we'll try to get you back as soon as possible so we can follow up on that prediction there. Tom, let's go over you. Anything else you want to tell us about your trading or orderflowedge.com?
Sure. Our edge is based ultimately on understanding that order flow is what drives price. So ultimately, we're crunching the order flow data to find value and opportunity as early as possible. But when it comes down to it, you have to learn how to think and act like the smart money would in the same situations that we find ourselves in, because they're always going to do whatever they can to spin you around and either have you thinking it's a good idea to sell when they want to buy, or vice versa. If they want to sell, they're gonna if they're looking to sell, they're gonna drive price up as high as they can.
And what's amazing is if you go back and read, and I've been going through eBay lately trying to find books on the market that are at least 100 years old, like Livermore and things like that. When you read those books, they say exactly that. Like they're trying to manipulate you out so they can get it at a better price. So that's kind of a fascinating thing. I'm glad you brought that up, Jason.
Absolutely. And today, in today's markets too, with the HFTs, they're programmed where if you're long where they're long, they're going to try to shake you off before they pop it. So they have the market come back down, and that stops a lot of people out of the move. Even though they might have got the idea right, they stop them out and then they pop it. So it's you can't win going against the smart money, plain and simple. And how do they do it? They understand market structure, how the market functions, and how to use that information to their advantage. The bots, the algos, the smart money traders, they all chase your stops. They know where and how retail traders and the trading systems that retail traders use, how they apply stops in the market, and they know how to take advantage of it. They know how to exploit that weakness. And if they can do it, why can't you? You can learn how to identify the structure, the manipulation, that you could see it in the market, and that's what influences price. And I just want to mention, if what we talked about here today, and understand we just scraped the surface here today, obviously, but if what we talked about here today resonates with anybody, we're going to be holding an open trade room Wednesday morning at 11, and I'd like to invite everybody to join us. The link is going to be orderflowedge.com/open room, or just email us support@orderflowedge.com.
Okay, cool stuff. All right, Steve, let's go to you, Lentz of optionview.com. Any closing thoughts? Anything else you want to tell us about optionview.com before we wrap things up?
Sure. A lot of folks, eventually, when it comes to picking direction, trying to make a prediction of where the market's going to go, get very frustrated. And if you're in that spot and you want to consider making money in a non-directional way, then options trading is a great way to go, and that's what we focus on. You can go to discoveroptions.com or optionview.com, where we provide the tool that really enables you to do that really well. Check us out. We offer just a huge array of programs. We have professional traders making money no matter which way the market goes, and also those professionally trading with option overlays, hedging long portfolios, and so forth. So that's what we're all about here. It's what we eat, live, and breathe. So thanks so much for having me on the show again.
I'm glad to have you. Good stuff. Glad to have you back. Again, my name's Dave Landry. I don't want to take too much time, but I do weekly webinars. This week I might not be doing one because of the holiday, but usually every Thursday I do Dave Landry's The Week in Charts. You can find that on my website. Bring your questions. Dress as casual. Drink plenty of fluids. And we usually have a lot of fun, too, and we don't take ourselves too seriously. Every other week, usually, or thereabouts, I do a nightly webinar, and I'll cover various topics. And tomorrow night, I'm going to cover IPOs. I believe in trading inefficient markets, and I think that's where the real opportunities are. And I'll go into that in a lot more detail tomorrow night. So if you guys are available at 7 Eastern, you can check my website, or you can check Timing Research on TimingResearch.com for some a banner ad on that. Would love to have you there. There's been a wonderful bull market in IPOs. It may end tomorrow, and if it does, at least you have the information, because sooner or later there'll be another bull market in this great country of ours. There'll be companies that will come public and do great. And one thing that's kind of interesting is even if they don't do great, there's some excitement in these companies And that's why I call the title the promise of the future, and capitalizing on that promise of the future. A lot of these things will run up significantly, even though there's nothing underneath them. So it's been really fun trading over the last couple of years, and I want to talk a lot about that tomorrow night. So stop by if you get a chance. Again, thank everybody for today. This was, I said this last week, but I'm gonna say it again this week. This was definitely one of our better shows. I'm humbled to be in the presence of you guys. It was a really good show. A lot of great points were brought up, and I think anyone watching, especially if they're new to trading, they need to really watch it and listen carefully, because a lot of great points were brought up today, especially when it comes to the trading psychology. All right, that's enough pontification for me. David Kosmider, let me turn it back to you. Thanks again for having me as your guest host.
All right. Yeah, thanks, guys. Good show. Just want to remind everyone, you can go to TimingResearch.com/report to download this or any past report there. Also go to TimingResearch.com/current survey later in the week or the weekend before Sunday afternoon, and you can download you can fill out the survey there. Just want to thank all my guests, Steve Lentz of OptionView.com, Jason Jankovsky of TheLionOnline.net, Thomas DeLello of OrderFlowEdge.com, and Dan Nyaradi of WallStreetSectorSelector.com. Thanks, Dan, for being here first time on the show.
Thank you for the opportunity. Great to be here.
And Dave Landry of DaveLandry.com. Thank you for hosting again.
Thanks for having us.